Hi. So I really just wanted to take the time and opportunity through this video to really explore the idea behind investing into China and specifically Chinese equities. So I do know many of you do hold positions or do allocate some of your capital in China, and it has been a heart-wrenching journey to say the least. But I really just wanted to explore behind why you should invest in China, or why Chinese equities do have a role to play in your portfolio, and also maybe explore some potential discussion points around whether to invest or not invest in China, and what are smart money doing today. And by smart money, they are essentially your big fund managers or people that actually have a lot of power because of the amount of capital that they have control over. So I think it doesn't come as a surprise that China has been lackluster. So for the US specifically, at least on a year-to-date basis, the S&P 500 is up around 10%, while the QQQ, which is the Nasdaq, mostly your tech companies, are actually up a whooping 31%. So this actually comes on the back where in 2022, they all had pretty bad performances. So if you just pull it out to a one-year chart, you can see that the performance is a lot more tamed because of this drawdown back in 2022. But I think in comparison, it doesn't matter because investors just want to know how do I make money today. But according to the year-to-date basis, Chinese companies or the Chinese counterparts, I don't even want to talk about them. Just look at KWEB, which is the Chinese tech ETF. It's down 18% year to date. And this actually comes from the highs, or at least they've been down by a large extent already. On a 5-year rolling basis, Crane Shares, which is KWEB, is actually down around 60%. So I think just to put some perspective and to shed more color around Chinese equities specifically, I added some of the comparisons, or basically many investors tend to look at these indexes or ETFs as some sort of proxy to the Chinese market. So your Hang Seng Index, which is the Hong Kong ETF, it's down 7%. The SSE Composite Index, I think it's the Shanghai Exchange, it's up 3%. The SZSE, that's the Shenzhen Exchange, it's basically flat year to date. And CSI 300 is basically like your S&P 500, but the top 300 companies in the Chinese market, China specifically. So it's not really relevant to the Hong Kong index. So you can see that out of the entire basket of ETFs, I think it's the internet sector that continues to be beaten down. So then many investors, or specifically many international or US investors, will be under the assumption that, hey, the Chinese market has probably no more room to go. The Chinese geography is uninvestable, etc., etc. And it's highly evident by the companies or by the indexes that they look at, and you have your famous Alibaba, Tencent, they're all down. Let's not talk about their performances here to date. So then when you look at KWEB, which is pretty representative, I mean, it has a few of your biggest Chinese companies. People will be under the assumption, yeah, Chinese companies, uninvestable, useless. Let's not look at them. And it's translated into your US fund managers. Evidently, they're the most underweight in Chinese equities if you were to compare them to non-US managers. Across the board, I think whether is it global equity funds, emerging market, or even Asia excluding Japan, they are all underweight. I think at least a point to note, under Asia excluding Japan, some of the non-US managers are kind of overweight on China as well. So which begs the question, is there really still a point, or are there still fund managers actively looking for value or actively investing in China? I think the short answer is yes, because in every market opportunity, or at least in every market, whether is it a bull or bear market, there are definitely opportunities. And in order for you to kind of beat the market or try to seek alpha, you probably can't be going into a saturated market. But that being said, I think for people that stuck to their guns and continue investing in the US market, they have been rewarded quite substantially this year. So I think one additional point that I wanted to kind of add to this entire discussion around investing in China really is, I think many investors, or at least for people that allocate large sums of capital, they really do so, or at least when they allocate money to China or Chinese equities, it's really for the purpose of diversification. They're not really there to kind of outperform the market. And by outperforming the market, by trying to generate alpha, you tend to do so only by trying to pick individual names, and so that they can front run the market indexes or your benchmarks. So specifically for people that do allocate to indexes, they're just trying to diversify away. They're not here trying to seek some sort of overperformance or outperformance over the S&P 500 or some of the most mature indexes out there. So I think just to square that away, from a diversification point of view, it makes sense. And I think I just wanted to point to the conclusion that MSCI did iterate, and I would like to reiterate here. And increasingly investable China is a significant opportunity for investors, and that includes A shares as they become more influential in the global equity markets. So in our view, A shares are necessary for a comprehensive, well-rounded exposure to China, whether through a broad country fund or a more sector-specific fund. For investors with existing exposure to China, MSCI finalizing the implementation of A shares on its indexes is a key development. So a larger share footprint in MSCI's benchmark indices may warrant adjustment to sector exposure to control for thematic opportunities. And I fundamentally do agree. And when I went to actually search up MSCI China Index, because I mean, contrary to popular belief, many people think that investing in all these broad-based China indexes, it's a waste of time. There is no room for all these Chinese companies. I beg to differ. So, I mean, generally, people talk about the S&P 500. They say that they have like 50, 100 years of performance. They return around 8 to 10% per year. But looking at it from its December 29, 2000 inception, on an annualized basis, they return around 7.22%. And 7.22%, I mean, it's not too bad. I'm sure if you look at the 3-year, 5-year, 10-year, it hasn't been doing good, to say the least. But I do still hold the opinion that I think for many of these Chinese names, they're essentially a sleeping dragon, waiting to be awakened. And there will be a sectorial and there will be a country type of rotation where people start to discover more value, and when a lot of all this news and noises start kind of dissipating away bit by bit. But of course, it's not going to be a short-term thing. You might need to be a lot more patient. At least that's what I'm doing. And I've been positioning my personal portfolio. I think I have like around 80 to 85% allocation in China. So I'm not sure if you've heard of this quote before, but I do believe that the best time to invest was yesterday, and the next best time is actually today. So although that the overall markets may still be slightly down compared to its all-time highs, but if you're to stretch out over a long time horizon, many brands that you use on a daily basis has seen an incredible amount of gains, and you should invest and also grow with your favorite brands, starting today with Momo Singapore. So some common brands that many people use includes Amazon, which saw a gain of 43% from 2018 to 2022, and Starbucks was up 89% in the same past 5 years. And guess what? Microsoft is up a whooping 195% over that same time period. So with that said, I would still like to remind all of you that investments do carry risk, and past performance definitely don't guarantee future results. So for those of you who have yet to open an account with Momo, they have an amazing promotion reward campaign, and you can get rewards worth up to 208 Singapore dollars. So all the promotion details will be down in the description below. So don't let this sweet deal get away so easily. And for existing users that currently have an account with Momo, don't miss out this opportunity to get some cash coupons. So just make sure you click on the link below. A big shout out to Momo for sponsoring this video. So I'm the abnormal one. Please don't follow me into this idea of allocating like 80% of your portfolio in China. I have my own reasoning and justification. Please seek your own financial advisor for the best sort of financial advice or things that are tailored to you. But I think I just wanted to kind of move your attention to this recent headlines from Financial Times. So I'm not too sure whether you guys are aware of this fund manager called Amundi. So the fund manager Amundi shifts assets from US to China. So this Paris-based firm actually attracted by valuations and says that investors have priced in too much risk. So for those of you who don't know, Europe's largest asset manager Amundi is moving out of US assets in favor of China, attracted by the country's brighter economic prospects, better valuations, and a more benign outlook for inflation. So Vincent, which is the CIO of the Paris-based funds of around 2.1 trillion euros in assets, thinks that too much risk is priced into Chinese credit and high-quality companies, while markets in the US are too optimistic as a recession looms. So in late January, a top US Air Force general actually predicted that the US and China would probably go to war in 2025. And it's quite ironic for a US general to say that, because I'm sure if a Chinese general were to say that instead, we are in it for a more volatile ride in the equities market. But anyhow, I think Mortier did say that the US should not underestimate the capacity for China to retaliate, to escalate, and then to negotiate. So I think China can make serious arguments to put pressure on the US as well. So Mortier is particularly keen on opportunities in selecting Chinese corporate bonds, arguing that foreign investors have been blanket selling without differentiating between the quality of issuers. So if you dig, you can really find good companies that you can buy for 50 cents to $1. He said, if you are brave or if you have some time, it's good. I think just some note here, I just wanted to put a pin here. Personally, I think I do share similar sentiments, which is why I kind of allocated around 10% of my portfolio to buy or to scoop up some of these Chinese banks. Particularly so when everybody was screaming Evergrande 2.0 or Lehman 2.0 around the entire Evergrande crisis. And I think for now, at least based on my entry prices, it's probably up, or most of my bank positions are up around 15 to 20%. So I think blanket selling wise, it's extremely normal. Likewise, I think for the entire banking sector in China, it's slightly overblown. I mean, I still kind of keep a pulse to the market, but I think there are opportunities if you know where to look. That said, I think investors should be even more cautious, especially when investing in this sort of distressed securities or distressed debt instruments. So another institutional investor that I want to point your attention to is Temasek. So Temasek, for those of you who don't know, is essentially the investment arm of the Singapore government. It's essentially like a sovereign wealth manager. So just to jog your memory a little, I think this article was sent back in 2020 or 2021, where Singaporeans in my own chat group, or particularly so in my own friends group, they were sending this around, trying to mock or trying to laugh at our Singapore investment arm, saying that the bet on Chinese tech companies have essentially went soft. And based on the disclosure that they have, many of the investments in many of these companies were caught up in the entire tech crackdown and edu-tech crackdown. So for some of the names that some of you might be familiar with, DD Global, New Oriental, TAL Education. So this is based on June 30, I think 2021. So if you were to just look at the share price, it's down like 42%, 77%, 79%. It's abysmal, and let's not kind of pour salt in the wound. But anyway, I think from this perspective, if I were to just quickly Google or quickly show you the charts of one of those companies, you can see that this is New Oriental Education. So this is one of the ed tech companies. At its peak, it was trading around $170, $180. Oh, sorry, it's actually closer to 200. And then from peak to trough, the trough is at around $10. So that's, I don't know, near 95% collapse. But of course, thereafter, from 10 to 37, it's up like 3x from there. This whole discussion around why many of these edtech companies went through such a pump and dump or such a huge cycle is really around the regulations around education and the for-profit idea. So let's not dwell too deep into it. And I think just from this incident alone, you might probably be under the perception that, hey, Temasek, once bitten, twice shy, right? They probably wouldn't allocate as much capital in China because of the changing regulatory environment and stuff like that. But contrary to popular belief, if you were to look at how they allocate their capital and their portfolio, so as of 2022, they still have an exposure to Chinese equities of around 22%. And 22%, yes, you can argue from the other perspective that from a 29% to a 22% allocation means that they're kind of losing faith and losing confidence. But that said, I think 22% is still quite a substantial amount, especially when you're running a $403 billion fund in this case. And if you were to compare it to the US exposure, US is around 21%. So there is still kind of a point into investing in Chinese stocks, specifically for diversification purposes. Of course, it's not for yield chasing, it's not for trying to strive for the best returns, because evidently, if you just want like the quote-unquote, air quotes, best return, many of them would just say that just throw into QQQ or Nasdaq specifically, and even the SPY might be lackluster in terms of performance if you want to strive for the highest possible returns from an index perspective. So that's just some perspective for you to kind of look into it. And some of you might bite back at me saying that, Chee King, you're biased. You're only showing us fund managers that are allocating to China. I think I've already made it quite clear that most of the US managers have already went underweight China, and also explains why many of these positions are essentially selling down, and the selling pressure just seems to can't stop. But I think, and at least from a portfolio management perspective, if you want to allocate your capital, really to diversify away many of these idiosyncratic risks or geography related risks, people, or at least many of these fund managers with big guns, by the way, 2.1 trillion in assets, 400 billion in assets, they're not shying away. They're putting in hundreds of, or at least from Amundi's case, they are putting in tens of billions. At least in Temasek's case, they are also putting in tens of billions of dollars into geographic regions where people say that it's uninvestable, or there's no point, or there's no value. So I believe that they all beg to differ. If not, they're not going to sink tens of billions of dollars, especially hard-earned money, into many of these geographic regions. And I think just to kind of tie up the entire discussion around China and investing into Chinese equities, there is this quote from Shanghai Macro Strategies. I think it's quite interesting. So whether China is investable going forward largely depends on two questions: whether the world is multipolar, and whether Beijing will strive to keep multipolarity. So if both answers are yes, non-US investors will profit from China at the cost of US savers. And I think there was this very interesting comment, or this tweet reply that I wanted to point to your attention as well. So no asset managers, endowment managers, insurer gets fired for allocating to the United States. If they allocate to China, they will have to spend 3 hours every month explaining why to their board, limited partners, etc. Unless your boss is Macron. So I mean that's just a joke. But anyway, there are a lot of people still allocating to Chinese equities. I think we are kind of just bounded by the myopic view that, in the US fund managers are under allocated. So let's just think that all Chinese equities or all Chinese stocks are uninvestable. And really just wanted to pump a bit of hopium for fellow Baba investors out there, for those of you who are betting on the Chinese recovery and hoping for some better results. So at least based on some of the data points that come out, the amount of money spent during the 2023 May Day holiday increased by 200% over the same period in 2022 and 70% over the same period in 2019, according to Alipay's May Day consumption insight. So hope you guys enjoyed the discussion. I don't know when this recovery is going to come, but I'm fairly confident that there is some sort of recovery that is bound to arrive to Chinese equities and many of these beaten up equities. With that, I'll see you in the next video, but more importantly, I will see you on the moon. Goodbye.